Marcus is sitting in a car dealership, new suit, smiling at the salesman. He just finished the best year of his life, $218,000 in gross income. He has investments, he has savings, he has a plan. 3 years later, Marcus will lose almost everything. Not because he was irresponsible, not because he made an obviously wrong decision, but because he reached a level of wealth where the pitfalls don't seem like pitfalls. They seem like opportunities. They seem like growth. They seem like the natural progression for someone who has reached where he is. A timeline is drawn on the whiteboard. One point is marked as today. Another point is 3 years ahead. Between the two, a series of decisions that seemed right at the time they were made. Most videos about wealth talk about how to accumulate it. Very few talk about the specific levels where loss is most likely. Not because the person suddenly became poor, but because each level of wealth creates a new vulnerability that the previous level didn't have. And vulnerability you don't know about is risk you don't manage. My name is Jack, and I spend a lot of time thinking about why people who have built real wealth over years manage to lose it in surprisingly short periods. If you've ever thought you've reached a point where you're safe, subscribe to the channel because this video is exactly about that. Before we begin, I am not a financial advisor. This is not financial advice. And I'm not here to scare you about where you are. I'm here to show you the map of loss zones that no one drew before you reached them. A staircase appears on the whiteboard. This time it doesn't just go up. It has holes. Some of the steps have a surface that looks solid but has a dotted line underneath. A hidden fracture. Marcus is climbing without seeing the dotted lines. The first level of loss is not the level of the poor. It is the level of those who have just emerged from scarcity. Income between $50,000 and $80,000 a year. Newly built emergency fund. First investment made. The feeling is one of arrival, that the worst is behind us. And it is precisely this feeling that creates the first critical vulnerability. A character appears on the whiteboard, confidently stepping onto a step. The step creaks. He doesn't hear. The trap here has a technical name: post-stabilization overconfidence. A person who has spent years in scarcity develops highly refined financial survival skills. They know how to cut back. They know how to wait. They know how to say no. When stability arrives, these skills become dormant, their guard is down. And it is precisely at this moment that the first offers that never came before arrive. A friend with a promising business needing a partner. A cryptocurrency that will triple in 6 months. A car that fits the budget if you pay in 72 installments. None of these things came when you had nothing because nobody offers opportunities to those who have nothing to contribute. The first savings in life is also the first target in life. FINRA data shows that Americans with assets between $20,000 and $100,000 are the group most frequently victimized by investment fraud. Not because they are less intelligent, but because they have sufficient resources to be targets and insufficient experience to recognize the patterns. The solution is a simple and rigid rule: no investments outside the regulated market, while total assets are less than 6 months of expenses times 5. Not because other opportunities are always bad, but that's because you still don't have enough of a cushion to absorb the mistake. The second level of loss is the most common among high-income individuals. Income between $80,000 and $200,000 a year. Growing investments, 401k contributed. Perhaps a property. Seems solid. Sarah appears. She has $140,000 of annual income. $200,000 in investments. A house with a $480,000 mortgage. And a lifestyle that consumes 92% of her gross income after taxes. On the outside, consolidated wealth. On the inside, a structure with a margin of error close to zero. The vulnerability of the second level isn't isolated overspending. It's an invisible concentration of risk. 3 elements appear on the whiteboard connected by lines: a single job as the primary source of income, real estate as the main asset, and a lifestyle calibrated to current income with no room for variation. Each element alone seems reasonable. The 3 together create a structure where a single event brings everything down at once. Job loss, illness, divorce, a real estate market correction at the wrong time. The Bureau of Labor Statistics reports that Americans between 35 and 54 years old with incomes above $80,000 experience income drops of 30% or more significantly more often than they imagine, especially in the technology, finance, and consulting sectors, where downsizing is cyclical. The trap here is called the illusion of diversification. The person has stocks, real estate, and savings. It seems diversified. But if all these assets depend on the continuity of the same job to be maintained, there is no real diversification. There is concentration with different labels. The solution is to build at least one second source of income that doesn't depend on the primary job before scaling the lifestyle. Not after. Before. The third level of loss is what destroys assets that took decades to build. Net worth between $200,000 and $500,000. Here the person feels rich enough to make wealthy decisions, but still lacks the protective infrastructure of someone who is truly rich. Marcus reappears. He has a net worth of $320,000. A business partner appears by his side with an idea, an opportunity for expansion, a joint real estate investment, a stake in a private company. The lines connecting Marcus to his partner seem solid: friendship, history, trust built over years. The third level trap is called trust without structure. Wealth has grown within informal relationships, verbal agreements, participation without a clear contract, joint investment without a defined exit strategy. Each of these situations is manageable when the amount involved is small. When the amount involved represents 30, 40, 50% of a person's total assets, a dispute, a different interpretation, a change in the partner's personal circumstances can lead to years of court cases and cost exactly what was invested, plus legal fees. The American Bar Association estimates that partnership and corporate litigation represents one of the categories of greatest asset loss among individuals in the United States, with cases beginning with disagreements that both parties thought impossible. The solution is not to distrust everyone. It's to structure every financial relationship as if the friendship didn't exist. Not because it will end, but because structure protects the friendship as much as it protects the money. The fourth level of loss is the most sophisticated and least discussed. Net worth between $500,000 and $2 million. The person has access to investment opportunities that didn't exist before. Private funds, real estate syndicates, seed round startups, angel investing. A door appears on the whiteboard. Outside, the character with average net worth. Inside, a room with well-dressed people presenting charts with ever-rising lines. The door only opens for those with sufficient net worth to enter. And the problem is that the open door seems like validation. It seems like you've reached the level where the good opportunities are. It seems like now you're going to really grow. The fourth level trap has a regulatory name. Accredited investor without commensurate experience. In the United States, the SEC defines an accredited investor as someone with an income above $200,000 per year or net worth above $1 million. This classification opens access to unregistered investments, similarly unregulated, with limited disclosure and liquidity often close to zero for 5 to 10 years. The regulatory logic is that those with more assets can absorb more risk. What the regulation doesn't say is that absorbing risk and understanding risk are completely different things. SEC data shows that investment fraud in private markets costs accredited investors billions of dollars a year, not retail investors. The most common targets are precisely people with assets between $500,000 and $2 million. Sophisticated enough to feel they understand what they are doing, and inexperienced enough not to recognize the manipulation patterns that only appear in these markets. The way out is a maximum allocation rule. Never more than 10% of total assets in investments, without immediate liquidity and without an independently verifiable history, no matter how obvious the opportunity seems. The fifth level of loss is the only one where the loss can be total in a matter of days. Net worth exceeding $2 million. Exposure to concentrated assets, a specific stock, a private business, real estate in a specific market. Sarah appears again. She has $2,300,000 in net worth. 62% of that is in stock in the company where she works as an executive, received over 8 years as part of her compensation. The number is large, the concentration is enormous, and she knows it, but there's a reason not to diversify. Diversifying means selling. Selling means tax. Tax means immediate and certain loss of a percentage of wealth. Waiting means maintaining exposure, but perhaps the asset will continue to rise. This calculation is rational. It's also the calculation that precedes some of the largest individual net worth losses on record. Enron, Lehman Brothers, WeWork. In each of these cases, there were employees and executives with significant wealth concentrated in the company's own stock. Wealth built over years, destroyed in weeks, not for lack of intelligence, for excessive closeness. When you know the company inside out, when you believe in it, when your identity is linked to its success, concentration doesn't seem like a risk. It seems like conviction. And conviction is the least suitable mental state for assessing the risk of concentration. The exit is mechanical and automatic. A predefined diversification plan that executes independently of conviction, independently of market outlook, independently of how much the stock rose in the last quarter. The decision is made once in a state of cold rationality, and then it executes itself. The sixth level of loss is the only one that doesn't begin with a financial decision. Net worth exceeding $5 million. A figure appears on the whiteboard. Around it, lines come from all directions. Family, partners, lawyers, accountants, wealth managers. Each line represents a person with access to the character's financial structure. Marcus appears in the center. He trusts everyone. He has reason to trust them. He chose well, and yet one of the lines is wrong. Not necessarily fraud. It could be incompetence. It could be an undeclared conflict of interest. It could be a manager charging fees that silently eat away at returns over years. It could be an accountant who didn't update the tax strategy while legislation changed. It could be a trust structured in a way that makes sense to the lawyer who created it, but will create a transfer problem that no one will discover for decades. Vanguard published analyses showing that seemingly small management fees, the difference between 1% and 0.2% per year, represent differences of hundreds of thousands of dollars in net worth over 30 years. Invisible, month by month. Devastating in the sum. The sixth level trap is delegation without supervision. When wealth grows enough to require professional management, the temptation is to delegate completely and stop understanding. The way out is the opposite. The larger the wealth, the more the owner needs to understand each structure, each fee, each decision. Not to do it alone. To know when something is wrong before it's too late. The seventh level of loss is the only one without a technical solution. Assets exceeding $10 million. The structure is correct, the assets are diversified, the professionals are competent. And yet there is a vulnerability that no lawyer, no accountant, no wealth manager can completely protect against. It's called poorly planned succession. Sarah appears older, seated at a table with her adult children around her. A lawyer presents documents. The wealth she spent 30 years building will be transferred to people who never had to build anything, who never felt the price of each step, who will receive the result without the process that creates the capacity to protect it. A graph appears on the whiteboard, a line representing wealth across generations without intentional financial education. The line falls, not in years, in decades. The American saying is based on data, from mango to mango in 3 generations. First generation builds, second maintains, third consumes, not out of malice, out of lack of context, out of lack of the process that created what exists. The solution is not legal, it is pedagogical. Transferring wealth without transferring the understanding of how it was built and protected is programming destruction with a notarized signature. The staircase appears in its entirety on the whiteboard with the holes visible. The steps have dotted lines underneath. Marcus is shown at different points over time. Climbing, almost falling, holding on, climbing again. Loss rarely comes from outside factors. It's rarely the market. It's rarely bad luck. It almost always stems from a combination of a specific level of wealth with a specific vulnerability at that level that the person didn't know existed because no one mapped it out for them before they got there. You don't lose what you've built by being irresponsible. You lose what you've built by applying the logic of the previous level to a level where the rules are different. By not knowing that each new step has a new risk that the step below never had. Marcus is back at the dealership. Smiling at the salesman, he signs the paper. He leaves with the new car. He doesn't yet know what will happen in 3 years. But if he did, the decision at that moment would have been different. Not necessarily not buying the car, but seeing what the purchase was, signaling about the entire structure around him, about the focus, about the margin of error, about what was fragile without appearing fragile. Knowing where you are is the first step. Knowing what can get you out of there is a different story, and it's difficult to have that conversation alone with just one video.